This video is neither a solicitation nor an offer to buy, sell stocks, options, futures, or any securities. The video and all contents are for educational and research purposes only. Please get the advice of a licensed financial advisor before investing your money in any financial instrument. Hello, swing traders. Okay, this is going to be a multi-part video, probably 2 or 3 parts. What I'm going to do is go over what is called buy rights, and also they're called covered calls. Now what we're looking at is a chart of Nucor, NUE. Now as you can see, for the past 8+ months we've just been in a nice slow channel trend, just up, down, up and down. And you could have made money on the pullbacks and then went on ahead and just bought maybe 100 shares of it and go ahead and take a small profit and just keep doing that over and over and over. And channel trades are great. I like finding channel trades, but what we're going to do is I'm going to show you how to make more money when a target is hit. And also when a target is not hit, you collect the premium and can write another call on the stock you own. Now, you really only want to do this on stocks that you own, okay? And I'm just going to use an example of 100 shares. And you own 100 shares and you write a contract to sell those 100 shares at a strike price. You collect premium and the capital, any dividends paid. And what I mean by strike price is a strike price can be $40, $41, $42, $43, and so on. Those are strike prices. And in the second video, I'm going to go over the strike prices. Now, only do covered calls on stocks you feel comfortable with. Because the thing is, when you do write a covered call on a stock, you're obligated to sell that stock. Now, let's say you own 100 shares of Nucor and you write a covered call that's like 30 days out. Well, that stock, you're basically renting that stock out. And you really only want to do this if you think the stock is going to move up. Because the thing is, if you write a covered call on a stock, and let's say you do it at $40, and all of a sudden some really bad news comes out, stock trades down to $30, well, you don't have control over that stock. You would basically have to buy back that covered call, and you would have to take control of that stock, and you would take a loss. So I only do covered calls on stocks that I feel comfortable with, and I have a handful of stocks that I follow that I like doing covered calls on. And also a lot of stocks that when you do a covered call on it, you want to make sure you get nice premium. There's no reason for you to take a risk and getting just low premium. What I mean by premium is the capital that you make, because you're basically writing the contract saying that okay, I own Nucor at $40. I'm writing the contract that I will go ahead and sell the 100 shares at $41. Now, and let's say you only want to do it for 30 days, okay? Now, you want to make sure you're going to get nice premium. You don't want to collect just $25 and tie up your money for 30 days, okay? So that's one thing you need to look at, and we're going to go over that in the second video. And also, you want to look for stocks that are trading in nice ranges. Maybe they're trending upward. You don't want to do this on weak stocks. And a lot of traders will do this. Basically, they'll buy 100 shares and they'll do one covered call, and they don't care about getting exercised or those 100 shares being taken out of their account, because that's what they want to collect the profit. Because if you bought it at $40 and the strike price is at $41, well, you get to keep the capital between the 40 and the 41 plus the premium that you collected because you were obligated to sell those shares. And a lot of traders will go ahead and do covered calls, and they don't mind getting those shares called away from them. They do that time and time again, and that's some of the strategies that I like doing. And also, if you own 100 shares of the stock, what you can do is you can keep writing those covered calls on the shares that you own, on those 100 shares that you own. So you can go ahead and do a covered call for like a strike price of $41. And let's say at execution that stock does not get called away from you. Well, basically, you get to keep the premium and you get to keep the 100 shares. And what you can do, you can write another covered call the next month. And you keep doing that over and over and over again until those 100 shares get called away from you because they've hit the strike price, things like that. And we're going to talk about that later, about stocks that are in the money, out of the money, what premiums to look for, making sure you're getting good risk reward for your trade. So I'm going to go ahead and stop, and we'll go ahead and do a part 2 on covered calls.